Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.
Good morning. It's Friday, July 30th, just after the close. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So quite a bit of volatility in these markets. I'm going to need to install a 5-point racing harness to this chair if we're going to keep it up with these types of $10, $15 swings in the silver market and $400, $500 swings in the gold market. So, make silver great again. That's the hat that I usually wear here after I shoot the video in the morning. And, I'm really not happy with the guy today. I got to tell you, when the overnight session, when I looked at the markets here today, the realization that the global markets saw that Warsh was going to be his Fed chair pick, the Fed independence fears, those started to diminish a bit. You saw this trigger a rally in the dollar index, and then every asset class except the VIX and yields were lower. If you looked at the grain markets, the FX currencies, cryptocurrencies, precious metals, stock indices, bonds, they were all lower. And we saw the VIX come up, we saw yields come up, and it really is this risk-off sentiment that goes across the globe. So the question is, this thing goes from $120 an ounce 2 days ago to down to $75 an ounce a few days later, or a few hours later, is that justified, So my take from it, and if you know me personally, I look at all these markets really from like a technical perspective. I look at these as tickers. I don't really have feelings, even though, I've been a stacker and things like that in my life. I shared a story at how I was trying to offload some silver early in the week and how difficult it was. And it tells you that the conditions out there, how the refiners weren't really buying and they were turning people away. They were offering them significantly lower premiums. And it just tells you when the volatility really picks up like that, people do get concerned. And my perspective is that I look at things from a technical perspective. I look at things from a volatility stance. And then in the end, I'll look at what the fundamental reasoning is behind it, because every single market, every trade has a story behind it. If you look at the silver market recently, and this is unobjectively looking at it, we have seen a parabolic move in recent weeks. Futures went from $82 an ounce on up to $121 in 13 trading days. So, and they rose on that. It was up 10 out of 13 days. It was higher, and it averaged about a $3 a day rally, with some of those being $4, $5, and $6 rises. And as the futures rose, one thing that we cover, and I covered on the Metals Minute every day, and a few things that I point out. One, what's the average true range? Well, gold, it was $150 a day, silver, $7.70 a day. So you get this explosive movement up. Of course, you're going to see that volatility explode. And I had talked to a lot of clients telling them that recently I was less interested in the 1,000-ounce silver contract, because if it falls $10 or $15 and then it falls again after that, you become in this position where you can't add to the position, and you become into a position of weakness rather than strength, where I believe that once they launch that 100-ounce contract in the next week or week and a half, you get those kind of pullbacks here and you could manage the risk a bit better. So that's why I personally have been less trading on things like the silver market and more focused on like gold and copper, where you can position size and right size and beta adjust your positioning. Something that we've been talking about is those ETF flows. And again, on silver, those ETFs year to date down 4.2%. So we've never really even gotten positive this year as far as the ETF flows. And what's that really tell you? Because we have rising volume on the trading, it tells you that the steady ETF liquidation which has occurred is mostly fund managers just right sizing their position, volatility adjusting and beta adjusting their position sizing. And at the same time, the trading volume increases. What's that tell you? It tells you that momentum traders, algorithms, and leverage longs have entered into the market. There's records amounts of trading in like SLV, ZSL, all these really leveraged products here, 2 and 3 times silver ETFs. And then when the prices, they rise faster than the underlying fundamentals during a short period of time, where you're going from like $82 on up to $120, those projected returns that larger participants have, their returns are pulled forward based on those fundamentals. So the market gets a bit ahead of the fundamentals. Those particular people trigger profit taking and the major players exit. And what it leaves is those momentum traders, the algorithms, and the leverage longs participating in the market. We've seen similar situations in Bitcoin where when futures broke 81,000, we saw $1.7 billion in leverage longs force liquidated. So you get back to silver, much of this recent rally was driven by those leverage longs and short-term trades because of the rising volume. And as prices begin to decline, stop loss orders are triggered, margin calls are initiated, forced selling accelerates the drop, and those three together become a cascading effect. It becomes in this thing where clients, and I deal with clients all out the day. At one time, several times throughout the day, I had 2 and 3 people on the phone at the exact same time with one in one ear, one on the headset, one on speakerphone, all at the same time. And a lot of the clients were saying that, hey, with this decline, let's just go to the sidelines. Let's reduce the position down. And they're doing it at the market. And those are also pushing those markets down. They are also triggering some of these different things, sparking algorithms to flip to short, sparking stop losses to hit, sparking those auto liquidations to occur. So again, this cascading effect occurs. Now back to why I'm upset with this guy, the Fed announcement, and it's, in one sense, they're saying that, Warsh, he is going to be an independent person. I'll get in that 1 second. You get Trump, his commentary today, he said that Warsh didn't commit to cutting interest rates. It would be inappropriate for him to ask him to cut interest rates. And that's really a 180-degree turn from the approach that Trump was having with Powell, where he was very critical. And what happens is that Federal Reserve, that sentiment shifts, markets price in a tighter policy in market conditions in the US, and you get the strong dollar, which pressures commodities, particularly the precious metals and silver, which reacts more than gold, and the gold-silver ratio bounces from 47-1 just yesterday to 58-1. The changes in the dollar strength, with them coming up, if you look at gold and silver, one thing that during periods of time when I cover the metals minute, I'll look at what's impacting those markets the most. Well, one thing I've been mentioning recently is, and I should be, is the correlation between gold, silver, and the dollar, which it has a 93%, this is gold and silver, 93% inverse correlation over the last 2 weeks to the dollar index. Meaning if the dollar goes up, you probably better believe that chances are that gold and silver are going to go down. And if you look at the dollar index, it's hitting 4-year lows. The euro currency's up at 120. These are kind of unprecedented levels recently. Now, while the risk aversion becomes widespread and the pullback is reasonable after some gains, and I'm not saying today's sell-off was reasonable. It was definitely an overshot because of these additional participants that have been in the market. I believe that the fundamental underpinnings are there for the precious metals rally to remain in place. And I believe that silver, the rise in silver and the rise in platinum and palladium and copper and aluminum along with gold really reflects a broad metals repricing. And you look at silver, you've got multi-year supply deficit, booming industrial demand, you've got EV, you got AI, you got solar, you've got data centers being built, you've got rising investment demand, you've got geopolitical risks rising. And I believe that these pullbacks, especially like this, like in the gold market, are going to provide a tremendous opportunity. And it's not just an opportunity for retail people. It's an opportunity for large people. Like just last week, we saw Poland's central bank, the world's largest reported buyer of gold. They approved plans to purchase another 150 tons as it braces for some heightened geopolitical risks. You look at what this sell-off occurred, and if you're a central bank, even though you're less impacted by prices, this is an opportunity for a central bank to add. You've got India. Their holdings of U.S. treasuries have fallen to a 5-year low because of some of these uncertainties going on. And what have they done? They've increased gold and other alternatives to take a larger share. And it really reflects this broader shift of some of these major economies going away from the U.S. bond market, going away from U.S. dollars and bringing up some of these hard assets in there. And if you remember, under Basel III reforms, and I'm not going to make this sound complicated, there's just rules for central banks on the assets they hold and how they are projected. And physical allocation towards gold is elevated towards what's called a tier 1 asset. Like in my house, this is like a tier 1 asset. What you have in your credit card, what you have in your wallet, as far as it's easily liquid and it's able to be borrowed against. Someone would borrow against this. If I handed it to the guy doing my lanai outside over the pool and I said, hold on to this, it's worth about $1,000, I'll get you the cash in a couple days, he would take it. I know, because the guy actually watches the Metals Minute. So just by coincidence. But anyways, these banks can now count on 100% of its market share, its market value towards liquidity reserves, placing it on par with cash and top-rated government bonds. So the significant reclassification that occurred on July 1st, 2025 is for U.S. banks, and it goes into effect so they can hold this. So I believe that these central banks are going to use this opportunity next week to really add to some positions and really do that while some of this deleveraging, while it may not be complete, I would expect to see some bottoming in action take place in early next week. So that's a bit of my take on here. The technical side, the volatility side, the reasoning with the inverse correlation, the reasoning with the Federal Reserve, the reason why we're seeing it all happen today. You also have month end. You got a lot of CTAs that were panicking that get paid on a monthly basis based on performance fee. They're seeing their performance slip away fast. You bet they're going to be hitting the exit buttons as well. So again, I believe that while it may not be over, while maybe some more margin liquidation may occur over into the Sunday night into the Monday, that we may see a capitulation point. Remember in April with the sell-off in U.S. equities, we saw a V-shaped recovery and one of the fastest recoveries we've seen. So if you have any questions, concerns, you want to learn more about how to manage risk, you could reach out. That's what we specialize in. You could send an email to info@bluelinefutures.com. You could register for some of our insights here. I do a daily video. I put out tactical ranges. I put out some key levels, some charts and stuff like that. And you could register for in the link or the description below. And then also, you do want to remember though, like anything, futures and option trading, it does involve risk of loss, may not be suitable to all investors. Good luck, good trading. Have a great weekend. Thanks.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.